Hi everybody, this is lecture for topic 10, ACT3113. Okay, in the previous topics, you have learned about assets, and then accounting for liabilities, and then accounting for equity. Last week you have learned about, you have seen lectures about accounting for equity. So this week, you will learn about how to prepare the financial statement. This is the financial statement for companies. So when you prepare a financial statement for a company, you have to the financial statement is quite complex because you know that companies are big businesses, and then companies are owned by shareholders. So there are many transactions related to shares. Like in the previous lecture, you have seen for shares, you have to know how to record the issuance of shares, and then you have to know how to record transactions related to events or transactions after a business or a company issued shares. Things like right issue, bonus issue, share buyback, dividend payments, etc. So when you prepare a financial statement for a company, then you have to aware that the financial statement is quite complex, and also you have to follow there are several things mentioned in the accounting standard. Okay, so let's see the how to prepare financial statement for companies. Okay, so this is the first thing. The first thing is you just to refresh your memory. This is the accounting cycle. The accounting cycle shows the steps that you have to follow when you want to prepare accounting record for a business, including a company. So the process is started with identifying economic events. When you identify the economic events, you have to analyze the events or the business transaction. You have to know the type of the transaction, the amount related to the transaction, and then after that you have to do according to this slide. After the identifying economic events step, you have to do recording process, records transactions. So in accounting, the recording process is started with you record the transactions in journals. The basic journals that we can use is the general journal. There are several more types of journals, but the basic one is the general journal. After you have recorded transactions in the journal, you have to transfer the journal entry to the ledger, and then you have after you have recorded everything in the ledger, you have to prepare a trial balance. That is the recording process, and then after that you have to do the next step. See step number 3 in this slide. You have to do adjusting entries. You do adjusting entries to mainly because you have to follow matching principle. And then the second reason that you have to do adjusting entries is to make corrections if there are errors in the recording. After you have done the adjusting entries, you have to do the next step, which is to prepare an adjusted trial balance. And then after you have prepared the adjusted trial balance, you can prepare the income statement, the balance sheet, the statement of equity, statement of cash flow and etc. Okay, these are the steps. So now, in the previous topics, you have learned about the recording process. You have learned about how to record the asset, liabilities, equity, revenue, and expenses. You have learned about how to record them. Now, in this topic, you will learn about the adjusted entries, and then to do the adjusted trial balance, and then to prepare the financial statement. Okay, these are very important things. These are very important points that you have to remember. This you have to remember this before you can do or prepare a financial statement for a company. Okay, the first one, fair presentation and compliance with MFRS. Okay, an entity or a company is required to present their financial statement of financial positions, financial performance, and cash flows fairly. Fairly means financial statement is prepared in compliance with the relevant accounting standard. Okay, so remember this. When you prepare financial statement for a company, you have to prepare the financial statement or present the financial statement fairly. Fairly means, in a simple way, we can say that it's supposed to show what had happened in the company. You cannot hide anything, you cannot be biased, etc. That is the simple way to say about the concept of fairly. So how to say that you have prepared the financial statement fairly? So the easier way to say is, if you follow or comply with all the accounting standard, then you are presenting the financial statement fairly. If you do not follow the accounting standard, then you are not preparing or presenting the financial statement fairly. Very easy. If a question asks you how to present a fairly presented financial statement, then the answer is you have to follow the accounting standard. Okay, the next point in this slide, presenting the statement fairly also requires faithful presentation of the effect of every transaction, event, and condition in accordance with the definition and recognition criteria for asset, liabilities, income, and expenses as mentioned by the framework. So the second point is you have to present the financial statement fairly. You also have to refer to the framework. The framework provide the general explanation about the financial reporting process and output and input, etc. Okay, the next slide. So to achieve this, to achieve fair presentation, a company is also specifically required to A. Select and apply accounting policies in accordance with MFRS 108. B. Present information in a manner that is relevant, reliable, comparable, and understandable. C. Provide additional disclosures when compliance with the specific requirement in MFRS is insufficient. So if you prepare a financial statement for a company, let's say in one aspect of it, or one item, or one method, you do not comply fully with the MFRS, so you have to provide additional disclosure. You have to show explanation about it in the notes to the account. Okay, this is the next thing. So the next thing is about the going concern and accrual basis accounting. So remember about this. When you prepare a financial statement for a company, financial statement of a company are only useful to users for making decisions when the entity is assumed to continue in business. This is the responsibility of management. If management is in doubt that the entity is able to continue to exist, they need to disclose such concerns, stating the material uncertainties contributed to such doubt. So remember this: when you prepare a financial statement for a company, you have to be able to assume that the company is a going concern. Going concern is a business that can continue to exist at least in the next accounting cycle. If the business cannot continue to operate, or if the accountant sees that the business cannot continue to operate in the next accounting period, then there is another way to prepare the financial statement. The financial statement that you have learned in this course is only for a going concern business, a business that is seen as can continue to operate in the future. And then if the management, okay, the management is responsible to assess the status of going concern of a company. If they think, if management the management has to say or mention or disclose in the financial statement the going concern status of the company that they are managing. Always remember, the financial statement is that you have learned in this course is only appropriate for a going concern company. If the company is not a going concern, then you have to use another format of income statement, another format of financial statement. And also, financial statements of a company should also be prepared under the accrual basis rather than the cash basis. An entity should recognize items as assets, liabilities, equity, income, and expenses when they satisfy the definition and recognition criteria for those elements, and not when cash is actually flowing in or out of the entity. So remember, there are two bases of accounting. When you learn about accounting for revenue and expenses, you have learned that in accounting we have two bases. The first one is accrual basis accounting, and the second one is cash basis accounting. Okay, so always remember, only accrual basis accounting is acceptable according to the accounting standard. If you want to prepare a financial statement for a company in Malaysia, in Malaysia and many other countries, you have to use accrual basis accounting. You cannot use cash basis accounting. So you have learned you have learned before what is the difference between accrual basis accounting and cash basis accounting. Okay, this is about another thing related to the preparation of financial statement for a company. So materiality and offsetting. Okay, let's see the first point there. An entity has to present separately each material class of similar items that are dissimilar in nature or in function. If an item is not individually material, then it should be aggregated with other immaterial items in those statements or in the related notes where some items might warrant separate presentation. Okay, this is about materiality. In accounting, we have a concept or principle of materiality. If an item is material, you have to show them separately in the income statement or in the balance sheet or in other statements. If the item is immaterial or not material, then you can group the items together with other immaterial item. That is you can group them together. You can group the immaterial items in material item with other immaterial items together and create an aggregate amount. And then after that, you have to explain that in the notes to the account. If you check the financial statement of a company, and then you will see they group together many small immaterial items or accounts, and they create one account to show the account in the balance sheet or income statement. And then when you check the notes to the account, you can see the detail in the notes to the account. So that is the thing. Okay, offsetting. An entity might consider offsetting assets and liabilities or income and expenses. This practice is not permitted by MFRS unless it reflects the substance of the transaction or other events. Offsetting might detract users of financial statements from the ability to understand the transactions, other events and conditions that have occurred, and the ability to assess the entity's future cash flow. So offsetting is like this. Let's say you are doing or prepare a financial statement for company A, and then company A has something like this. Company A has account receivable in company B. Company A owe company B 50,000. At the same time, company B also has owed company A, let's say 40,000. So company A owed company B 50,000. Company B owed company A 40,000. So offsetting means in the balance sheet of company A, you show only company A owed company B 10,000. That is offsetting. Why you show 10,000 only? Because you think that company A owed 50,000 to company B and company B owed 40,000 to company A, so the difference is 10,000. So you think that you want to show only in the balance sheet company A owed company B 10,000 only. That is offsetting. That is not allowed by the accounting standard. You cannot do that. You have to show everything. You have to show company A in the balance sheet. You have to show company A owed company B 50,000 in the liability, and in the asset you have to show company B owed company A 40,000. You have to show both. You cannot offset. That is not allowable by in the financial statement in the financial accounting standard. Why it is not allowable? The reason is in the second point. Offsetting might detract users of financial statement from the ability to understand the transaction. If you put the offsetting amount only, and then people or user of the financial statement cannot understand the the actual thing that happened between company A and company B. You have to show everything. It could mislead users into understanding differently what is presented in the statements of the current position and condition of an entity. When you offset, you, the accountant, can understand what had happened between company A and B. But users, the financial statement users, like investors, they cannot understand the offsetting amount. Okay, this is another thing that you have to understand about the financial statement of a company: frequency, comparative, and consistency. Okay, so we look at the frequency first. Financial statement must be presented in a timely manner to make it useful and relevant. Okay, this is related to frequency. A frequency at once a year is the minimum. If an entity requires a longer or even a shorter period, it must justify such practice and declare if the information are in fact comparable. Okay, so frequency means that every company has to publish their financial statement at least once a year. That is the requirement. So it is a regular frequency. Regular frequency. Every year they publish one financial statement every year. That is the minimum. If a company requires a longer or a shorter period, it must justify such practice. They have to explain. If you check the financial statement of companies, you will see that most companies they will present or publish their financial statement once a year, no problem at all. But sometimes you will see that a company they publish the financial statement. They sometimes they need longer period. Sometimes they publish in a shorter period than 1 year. They have reasons for that. Sometimes they make it longer because there is an issue with the business. Maybe there is a merger, what I call as restructuring of the business, etc. Sometimes I have seen a company they make it shorter, shorter than 1 year. The reason is the company have been taken over by another company, so they want to make it earlier to show when they take over the business, this is the thing that the business has. And then the next year they do it for every 1 year, so that thing can happen. Okay, and then the next thing is the comparative. I think comparability allows the assessment of trends in financial information for predictive purposes. The Malaysian Financial Reporting Standard require an entity to disclose comparative information in respect to previous period for all amounts reported in the current period's financial statement, both narrative and descriptive. So when you prepare a financial statement for a company, actually you have to show the financial statement for this year together with financial statement of the previous year. That is the requirement made by the financial reporting standard. When you show two data, current year data and previous year data, the investors or the users of the financial statement can compare these two data, and they can make good conclusion whether the business is getting better or getting worse, etc. So that's why if you see financial statement for a company, they provide 2 years data, current year data and previous year data. That is the requirement made by the financial reporting standard. Every company has to do the same thing. They have to show 2 years data. Okay, and then the last thing is consistency. Consistency is also a must. The same items will be incomparable if in one period the items were classified under a different class and in the previous period. Making relevant judgment for these items would not be possible. So consistency. As far as I know, the easiest way to explain about consistency is like this. In accounting, if you use one method to record an item or to record an item or to calculate something, you have to be consistent. This year you use this method, next year you have to use the same method, and the next year also again you have to use the same method consistently. You have to make it consistent. For example, in accounting, you have you know that to calculate depreciation, you can use at least 3 methods. You can use straight line method, reducing balance method, unit of production method, etc. I think that are the 3. And then if you use straight line method this year, you for non-current asset, and then you have to be consistent. Next year you have to use the same method again, and then in year 2022 you have to use the same method. So you have to be consistent. Why you have to be consistent in the recording process? Because when you consistent, you can compare the data this year and the next year data. If you are not consistent, then you cannot do good comparison. Let's say this year you depreciate your building using straight line method. Suddenly next year you change it to the reducing balance method. So then when you compare the financial statement in the year 2020 and the year 2021, you cannot make a good comparison because you have used 2 different methods. So make sure so you should aware that when you prepare financial statement for a company, you have to maintain consistency in the recording process and in the methods that you use in the recording process. Okay, this is the end of lecture number 1 for this topic, and then thank you very much. You can communicate with me in the comment section.